What's up, everybody, and welcome back to MF1 Dividend Investing. This is episode 4. Today's episode, we're going to talk about GameStop. You can't, how can I not do a video this week that doesn't mention or focus on GameStop? It's the talk of the world, I think, right now. So it's a bit of a tangent from my typical videos. If you've watched some of the other videos, you'll see that my M1 Finance portfolio does not include GameStop. Also, if you're familiar with the GameStop stock, you'll know that it does not pay a dividend, so would not normally fit into dividend investing, though it was a dividend paying stock a few years ago. I'm also bringing this up because, or to discuss, because I actually own a few shares of GameStop. I've owned them for a while, actually well before any of this craziness started to go on. So I just want to walk through kind of my thoughts on GameStop and where it stands today, and my opinion on why it's the price is shooting through the roof as of the last couple days. So just to start things off, right? Anybody who doesn't know, right? GameStop sells video games, consoles, collectible toys, etc. A few years ago, they also owned AT&T wireless stores. I think Cricket and Simply Mac stores as well, but they did sell off some of that business in the last year or two to kind of refocus on their gaming side of the business. But that's GameStop in general. And then, hey, for anybody who doesn't know what's been going on the past week or so, here is GameStop, right? And you can see this is why it's the talk of the town. It was trading at the beginning of the year $17-18 a share. Here we are a month later, and it's at $325 as we speak, which is almost 1,800% gain within a month. And if you want to see that over the last year, that number really jumps up to over 8,000%, as it was trading at $4, I think as low as two something in early March when the pandemic first hit. So to go from $2 to $300 in less than a year is a pretty incredible story. So how did we get here? Well, it doesn't have to do with fundamentals, I can tell you that much, and nor should it really. This has to do with the technicality of the market, and if you've heard any news or seen any other videos, you know that technical thing that's going on here is the battle between short sellers and long buyers, or in this case they're saying it's the retail investors versus the institutional hedge funds and whatnot, who are shorting the stock. And the price jump, yes, is I think very much a factor of short selling. Okay, so here's just a real basic example, super simple example to try to explain what short selling is and who a short seller or how they go about doing a short sale. So essentially, if you're a short seller, that means that you think the stock is going to go down in value at some particular date in the future, and you want to capitalize on that. So what you do to do that is you go to a broker and you say, hey, broker, let me borrow some shares. In this case, it's 10 shares of ABC stock. Now, the broker will give you those shares or loan you those shares. You're not actually purchasing them, you're borrowing them. So much like if you borrow money from a bank, right, you'll pay an interest rate. So you'll pay something to the broker to be able to borrow those shares, some interest rate. And that would likely depend on a number of factors with the stock of what that interest rate would be, but you got to pay something to borrow the shares. Now, once you borrow those shares, which you don't own, right, you go to the open market and you sell them at whatever that price is at that time. In this case, you can see the seller has the 10 shares, he puts them on the open market and he gets $500 for them. At some date in the future, your prediction was correct, right? The stock goes down in value, and you as the short seller can now purchase shares on the open market. And in this case, right, it's the 10 shares, but you can purchase them for less money. And in this case, it's $400. So now you own 10 shares. You owe the bank, or in this case, the broker, you owe the broker 10 shares that you borrowed from him. So you bought 10 yourself at this later date for less money. You then go back to the broker and you return those 10 shares and you pocket the difference. And in this case, that's $100. And that's a real super simple example of what short selling is. It's basically that you're betting the stock will go down. You use borrowed shares that you then sell on the open market in the hopes that at a later date you'll purchase them back for a cheaper price and return them to the broker, and you keep the pocket the difference. So it's a pretty normal thing. I would say almost every company is probably sold short at some percentage. And just to give you an example, let's look at Apple, which is somewhat of a darling of the market. Even as it continues to climb and climb and climb and go up. All right. If we look over here to the shorts float, you can see that 0.6% of Apple stock is actually sold short, right? People betting that it's going to go down at some point in the future. So if that's the case and stocks are sold short, then why is GameStop so different, or what's going on with GameStop that makes them so unique to the situation? So when we pull up GameStop, right, you'll see a couple kind of unique things here that make GameStop kind of a one-off here, and why it's the focus of all the news right now. The first thing you'll notice is the shares outstanding. There's about 65 million shares outstanding, but out of those shares, the float is 50 million. And the difference between outstanding and float is basically open market shares that can be kind of bought and sold on the open market at any given time, where shares outstanding include restricted stock that may not be able to be sold on the open market at that moment. But then the interesting thing here, and the real kicker, right, is the float, the short interest, the float, right, of the short shares, 122%. Now, I just had Apple up on the screen. It was 0.6%. GameStop, 121.98% as of right now. And this data may not be perfectly correct, but that's what's coming up on the screen now. And I believe at the height before the crazy takeoff on the price jump the last couple of weeks, I believe the float, the short interest as a percentage of the float was as high as 140%, if not more. Now, if you go back to my basics of shorting little chart that I had here, the question I think that should be clicking in your head is, well, wait a second. How do you get a short interest that's more than the float, than the shares available? Right? How did a short seller acquire more shares? All right, let's just look at this as one person, right? How did they get 140% of the shares? That they don't have them. They don't exist, right? How does that even make sense? And that's the $1 million question, and that's why you're seeing what's happening right now. You have a company that's overshorted, and there's no shares available. I mean, here you are with GameStop, right? That's got 122% of its open market shares short. So if there's a catalyst or a reason that these short sellers need to all close at the same time, it physically can't be done. There's just not enough shares available. That they don't exist, right? If there was 100 shares in the entire company, but 120 of them are short, and everyone goes to buy at the open market to return to the brokers, there's 20 shares that just don't exist, that aren't there. And I know this is a very simplified version of it, but that's essentially the long and the short of what's going on here. And the biggest problem, the biggest thing, is the catalyst, right? So as I was kind of saying, right, GameStop has been going up in value a little bit off its lows of $4 because it's been getting some news. But I think the real kind of attention and spike in the price that you've seen in the last couple of weeks is that people caught on to this short interest. And, in particular, it's been discussed on Wall Street Bets, that, hey, wait a second, the float here for the stock in general is very low. There's only 50 million shares to begin with, and probably a bunch of those are tied up with institutions, that aren't buying and selling on the open market on a daily basis. So this number may be even lower, and then you have now a bunch of retail investors that are buying this stock. And honestly, when the price was still lower, there was a valuable reason to buy it on a fundamental basis, and now there's a technical reason to be buying it. So I don't think it's irrational for anybody to be buying this stock right now. And I know in the news and a lot of the articles that I'm reading, they're saying, this is irrational. It's detached from its fundamentals. This can't go on. We have to stop people from buying it, which in my mind is really kind of shady. And it seems something nefarious is going on behind the scenes, because stocks always are somewhat detached from its fundamentals, and its in reality in general. I mean, look at the stock market over the past year, that we had the pandemic. GDP goes way down, but stock prices go way up. Should the entire market have been halted, or should people have been prevented from buying and only allowed to sell over the last year? The way people make money in the stock market is when it becomes inefficient, and that's just part of the market. It'll run up and it'll run down, and there'll be corrections. So the to say that it's irrational and you need to stop people from purchasing the stock now, I think is a bit uh, of a lie to say that. But that's my personal opinion on it. And we'll have to see where things go. But that's essentially what's happening here. We have a possible short squeeze, which I don't think has even occurred yet, where all these guys, as this price goes up and up and up, anybody who's short this is one, bleeding cash through the interest that they're paying on it, but two, the paper loss before they actually have to cash in just gets bigger and bigger, and then it becomes kind of a game of chicken. Okay, who's gonna run and grab those shares first, and at what price is that going to be? And if you have a bunch of people that are not willing to sell, or just the interest itself in the shares that are available is very low, the price is going to spike up, and that's normal. That's what's supposed to happen here. So we'll have to see what happens, in the next coming couple weeks. But that's the basics of what's happening in GameStop, and it's been interesting to kind of see the ride. But it really, I think you need to put the onus here on the short side of the trade, not the people on the retail side. And part of the reason of that is there was very rational reasons to see that this company was not dead, and I think it was kind of priced for dead, and left for dead, or even tried to maybe help it along the way, some of these short sellers. And I can kind of get into that a little bit just by looking, but I think for now I'll save that for another video, because this video is already going to be too long. So I'll try to get that out, if not later this week, maybe next week, and go over my analysis of GameStop and why I bought it when I did, and kind of why I held it through the ups and downs that we're currently seeing, but also prior to this. I bought it in 2018, and the share price from when I bought it to its low in 2020 was close to 90% loss, but I didn't sell, and obviously that was probably a good thing to do, seeing what's happening now. Where it goes from here, who knows? But that's that. I'll put that into another video for you guys, and then that may be like the first kind of fundamental analysis I do on a stock for you. And I think it's a good one to do, because it's such a hot topic right now. So with that said, that'll be the end of the video. Appreciate you guys sticking it out, seeing to the end. Like and subscribe. Anything you didn't understand, anything you want to know more about, put a comment in below. I'll try to get to it or answer your question in the comments if I can. And I'll see you next time. Thanks.